I think it would have to show that there was some follow through and some urgency to the release of whatever the Mueller investigation is ultimately going to do. And if that, in fact, lands it in Congress right now, given the stalemate and the shutdown, that has a lot of volatility producing potential. And certainly in my area, I think you're going to see maybe some pressure on treasuries, especially as we've kind of got to these low yields, relatively low yields over the last couple of sessions.
You know, we've seen the market's looking for a smoking gun. Until we find that smoking gun, until we find that direct relationship with President Trump, then the market is going to discount all of this stuff. It's already been discounted already. And unless you have that connection, the market just says, OK, show me when you have new information. And that's what you were seeing today. Yeah,
show me. You agree with that, James?
Absolutely. I don't think that the indictment this morning is going to have a market-moving effect. The market-moving effects are going to be continued growth, decent earnings, and kind of what I think is going to be a separation between Company A and Company B. And that's what we're really looking for, a stock picker's market, a bond picker's market, in an income space that is a lot more generous, especially for income strategies and the like.
When you say that more generous for income strategies, I guess that means you think the credit markets are in good shape because these somewhat higher yields, let's say for corporate bonds, look like they're relatively safe?
You know, I think it's not only the corporate side, but any kind of the capital structure that pays an income stream. If you look at the performance in 2018, there's really been a handoff between the more growthy names and the more value-oriented names, both on the debt and in the equity space. So you have now sort of a reset of yields with the Fed having moved 4 times. You have an outperformance of companies that are reinvesting in themselves, the CapEx acceleration, and the companies that are rewarding shareholders in the form of ever higher dividends. So I think that sort of safe income space, that sort of tried and true strategy, is going to look relatively attractive vis-a-vis the momentum, the high flyers, and the non-paying type securities. Credit markets are stretched. The high yields had a big rebound here with equity markets. I would be very cautious of going purely into the debt side for income. Let's be kind of agnostic about what part of the capital structures we use, and it's a lot better space than it was just 2 years ago.
James, let me go back to the president for just 1 second. You know, we had a monster rally kind of right up until the tax cut was passed last year. And then, frankly, through kind of August, September of last year, but now we've given a lot of that back. You know, a 2-year chart so far kind of shows we're right back where we started from. What would it take for investors to get optimistic or bullish all over again about this administration?
Boy, that's a tough one. I think confidence has been shattered a little bit, and that was one of the big reveals of the Trump election. There was huge CEO confidence, huge consumer confidence, and all of the wrangling that's going on, I hope just temporarily, is certainly putting a dent in that. We're seeing some comments out of the Davos conference that CapEx may slow, that CEOs are starting to get a little more leery, and that could be a real wrench into what would otherwise be a very good economic backdrop.
James, when you look at the American investor and investors as a whole, we got a crash course on quantitative tightening. When you look at the Fed, even if they pause, if you have upwards of $50 billion coming off the balance sheet per month, that is still tightening, no?
Yeah, and that's really the credit conditions generally are tighter. You mentioned earlier the credit market spreads did get quite a bit wider in December. Volatility is higher. Equities are more had a downdraft. So all of those are a tightening environment for the economy. And the Fed right now is up against it. I mean, the market has told it that if you continue, the yield curve is going to invert and we're going to have a slowdown. I think what we've seen is the Fed put, for lack of a better way to say it, is no longer 10%, but 20% sure got their attention.